In your latest note, you talk about the current environment as being yet another new normal. I do wonder how you see Asian banks positioning themselves for growth and returns in this environment of high rates, high inflation, and probably weaker growth.
Hi, morning, Paul. Thanks for having me. Yeah, it is. It's an issue, as you said. It's a conundrum. Slightly better growth, but inflation being so high ultimately will have an impact, because much higher inflation means Western, especially US Fed, hiking and staying high for much longer has implications for growth in US, and a lot of Asian countries rely on exports. And as a result of which, it will have implications on credit demand and ultimately credit quality over the next 12 to 18 months. So it's a fine balance that a lot of financial services industries have to manage. But ultimately, what we expect is banks with good fundamentals who can generate capital and distribute capital, more importantly, will be in a much better position.
Let's take a look at China banks, particularly as the country exits COVID. China also dealing with a lot of well-publicized issues around its property sector. What's your outlook for financials in China heading into the first few months of 2023 as this bumpy road out of COVID zero gets navigated?
Yeah, as you said, this is a bumpy road, and we'll see how it gets navigated. But there's, in addition to the COVID zero being exited in phases, there is also a matter of property being managed. And what we are starting to see is, as we start getting some degree of confidence on some of the work in progress projects getting completed, some of the banks where the risk premia has increased significantly because of the property portfolio, some of that probably offers a bit of a trade over the next few months. But ultimately, the more medium-term outlook depends on how does the new normal for growth in China looks like, and that remains to be seen on how various policies evolve over the next 12 to 18 months.
Harsh, we have Governor Haruhiko Kuroda in Japan speaking at Parliament right now, saying that the benefits of easing exceed its costs, that the BOJ will communicate the exit strategy when price goal approaches. Their objective will still take time to achieve the BOJ's goal. It's too early to discuss about policy framework. So basically, Harsh, we really have seen Japan as being one of the exemplary countries where the rate versus the FX trade-offs are very, very clear. What are you seeing in terms of where Japanese banks could go from here and what's important to them?
Actually, that's a very important point that you made on rates versus FX. And we have a very wide continuum on that. On one hand, we have Japan, where no movement in rates and FX is taking is the factor, which is the adjustment factor. And on the other hand, we have Hong Kong, where there is no change in FX and rates is moving. Singapore, similar. And then you have all the countries in between. So various countries have different ways of managing based on their reality on potential GDP as well as the leverage. So as rates go up, there is going to be some benefit on the pre-provision operating profit level. But ultimately, what it also we need to see is how these higher rates impact the debt servicing ability, especially for the 90th and 95th percentile borrowers. And the more it starts impacting debt servicing, larger is impact on credit quality. So again, we have to go literally country by country, bank by bank, and figure out which effect on either rates or as in rates led higher profits or credit quality is a bigger driver.
And what about balance of payments, fiscal balances as well? How do they affect the banking outlook?
So it is quite an important driver because ultimately FX is a function, or the moves in FX is a function of current account as well as capital flows. And if FX becomes almost a one-way trade, it starts impacting capital flows, which then becomes a bit of a problem on domestic liquidity. So those are the aspects which I guess all the policymakers are trying to address. And over the next 6 to 12 months, I think that conundrum is probably going to be a bit more pronounced if Fed rates go higher and stay higher.